Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending December 2nd, 2022. And this week I'm going to title the video Santa Claus Returns to Markets for Now. And I wanted to pull this up because, the Trader's Almanac is something you always want to pay attention to. It's not the end all be all, it's one factor, but since 1950, the S&P 500 is up 80% of the time from the Tuesday before Thanksgiving to the second trading day of the year, averaging about 2.7% on the S&P, 3.4% on the NASDAQ. You can see that data here. This goes back to 1979. This one back to 1950. But you can see how just pretty consistent it is. Right, so 58 up, 14 down, 34 up, 9 down on the Russell, because this only goes down to 79. But basically, the November through January is the three best consecutive months of the year. Consecutive. Now, there's also the January effect, small caps outperforming large caps in January, which usually starts now in mid-December, and we're now a couple weeks away from mid-December. And we'll talk about how small caps are currently outperforming and likely to continue, at least the near term. So I wanted to bring that up because that's what we're in the midst of, kind of that Santa Claus rally. And, you don't want to miss it. Let's just say that. So let's dig into the data before we dig into the charts. And the ADP report came out on Tuesday or Wednesday. And that was 127,000 new jobs, certainly the lowest of the year. So that was pertaining to a weak jobs report on Friday, which we'll get to in a second. But then we also had GDP that was 4.7% quarter over quarter. Excuse me, that was the price index, was up 4.7% quarter over quarter. So a sharp deceleration in the price index. The actual GDP, that ticked up just about 2.9%. So what it shows you is that, we had, these 3 months here, or 3 quarters from Q4 through the first half of this year. It was all jumbled because of what was happening with the supply chain. We got that backup in December, or in the fourth quarter of last year. And then there was destocking in the first and second quarter. And now the third quarter, you had a more normal quarter, right? Around 3%. So what it shows you, remember, this is lagging. So this doesn't matter that much, but it shows you, that was the market getting ahead of itself in to a recession, right? Looking at those negative GDP numbers, potentially. But that also could mean that the worst of the economy could be ahead as well. So you have to think about it that way too. So you always have to invest through the windshield, not the rear view mirror. It's always very important to keep that in mind. Now, pending home sales, obviously this is more real time. The real GDP number, that was for the third quarter. We're approaching the end of the fourth quarter. So this doesn't mean a whole lot. But the pending home sales, that does, down 37% year over year. And I think that's going to continue on with its weakness. Obviously, you're going to get a little bit of strength of buyers coming back with rates coming down, but it's going to be pretty modest. Core PCE, the price index month over month, that was up 0.2%. So that was a nice number on the inflation front. And then the manufacturing index, that came in negative. So under 50 is negative, is shrinking, 48.4. And now it's the lowest of the year. This was kind of that destocking phase in the first part of the year. But it's just showing, continuing deceleration in the economy. And I kind of say right now, real time, we're in stall speed. Going forward into the first half of the year, that's probably going to where you're going to see the recessionary environment. But the question is, how much is that built into markets? Now, the manufacturing prices paid index, that came in at 43, the lowest level of the year, further showing that the inflation picture is decelerating fairly rapidly. Now, non-farm payroll, that came in at 263,000, beat estimates. But that was mainly on part-time jobs, so it wasn't anything really to write home about. So you don't want to get too jazzed up about that. It was more seasonality than anything. Now, the CME index, Our CME odds are 78% that we're going to have a 50 basis point hike in December 14th. So we're coming up, not next week, but the week after, we're going to have the Fed meeting. And that's often a catalyst. Buy the rumor, sell the news of a Fed pause, slowdown. I think that could be a potential setup here going into the middle of the month. Now let's take a look at the markets. First, I want to look at the NYSE. And I always say this is a much better index to follow. It's a broad index, 2,500, 3,000 stocks, something like that. And this is quite the rally in just the span of, look at this, is about a month and a half. This has been a pretty vicious rally, counter trend rally, a lot of short covering. I talked about how bad sentiment was, how offside it was. And we're working that off for sure. Now, some positives are the MACD is above the zero line. Let's pull it back to the weekly. We're not quite above the zero line on the MACD, but we are overbought on our percent R, on the stochastics. So we're up into that 100-week moving average, And then the 618, here's the 618, this green line, right into it, hit it on Thursday, and yesterday just kind of backed off a little bit. But we could consolidate to break through, just like we did in the S&P, right? We consolidated 382 for about a week and a half, and then we broke through this week. Now, right above the 200 moving average, beat it from where we were in August. And we still have some more upside targets here, 41.60, potentially 43.14 on the S&P. Could we get there? Absolutely. Are we guaranteed to get there? Absolutely not. So you have to realize that there's a lot of overhead resistance. We're getting into, look at the volume here. So look at the blue over here on the right. So this is volume at price. And you can see as you get up into 4,400 especially, but even starting around 4,200, that's where the actual real volume starts to pick up, and you start to get into some overhead resistance. So I think the market at the very least is going to have trouble initially getting through that 4160 mark on the S&P, but we shall see. Inflation, higher prices, and the fact that the dollar's going down is actually good for markets. I know it sounds weird, but remember, 2008 was a deflationary force. It was deflationary. Prices were going down. Home prices were going down. People weren't spending. People are spending still. People have money in their pockets. And you see that with, Black Friday season was roughly flat. I talked about it on the show. I believe that was on Wednesday. And it wasn't great. It was fine. It was stall speed, kind of flat from year over year. So the dollar is something that, though, is now becoming a positive for markets. It was a headwind to markets through most of the year as the dollar just skyrocketed. And now this is coming back down, something that you have to be cognizant of. A weak dollar is good for asset markets. It inflates asset markets. It makes risks of monetary tightening spreading into some sort of systemic event much less. You see what happened in Sri Lanka, in Japan, in the UK with the strong dollar. Those are the type of things that dries up liquidity, and forces those entities to sell assets. Think of the UK and especially Japan. What was Japan doing? Japan, when they had their problems, they were selling treasuries, and that pushed treasury yields higher. Now, if the dollar is weakening and the yen is going higher, right, that's less pressure on what's happening over in Japan. So that's a huge now tailwind to the markets, okay, and something you have to continue to watch. Now, let's take a look at growth to value, IWF to IWN. You have had a little bit of rebound here on the week on lower rates. But what's interesting is it's not really getting a ton of traction, to be honest with you. ARC not getting a ton of traction. So you would think that with the 10-year coming down so significantly, this is from 4.25 all the way down to 3.5. That's 75 basis point drop in the 10-year. That's pretty big. And you would think that the growth stocks would get some traction. They're really not. Okay. Now I want to touch a bit on the VIX. The VIX new lows. I've talked about this last week. I said, are we going to get new lows Monday? We got a pop in the VIX and a rollover, and we now have a lower high and a lower low. That's positive for markets. Okay. Look at the volatility, the ratio of the volatility, the VVIX to the VIX. This is one good one to watch. Look how it's going up. See how this is breaking out to the upside? Look at the weekly. Okay, this is going back to 2008. Remember the 2008, market sell-off? Remember Christmas time, the one of those years where the Santa Claus rally didn't happen for sure? Look at this. This is plummeting. Okay, then you had the COVID crisis. This plummeted. Right? And then you had a good market. This was going up, right? Once the market bottomed in April, May of 2020, this went up, and then it peaked kind of summer of last year, and it really rolled over in the fall and was in a downtrend. Now, if this is an uptrend again, that's good things for markets. Okay? And you have to, we're umpires calling balls and strikes. You can't come with this with some sort of a bias. You really can't. Now let's look at short-term rates. That also is breaking out to the upside. That's SHY. So short-term rates are coming down. That's definitely a positive, showing the Fed is likely to pivot here coming up. Now gold's breaking out. Here's GDX, now above the 200-day moving average. GDX to the GLD. That continues to break out above the 200-day moving average. Look at the junior miners to the senior miners. That is starting to move higher as well. Silver to gold ratio. Silver just crushing. This is a clear breakout. So the precious metals looking very, very healthy. XLE, this is the energy space. That pulled back a bit. The oil's been relatively weak, but I think this is more short term. If you look at the longer dated contracts, they're not selling off like what you're seeing here in the USO. So or in oil prices in general in the near term. So I think there are dips to buy continually in the energy space, but you could get a more protracted downturn by year end. You have IYM that continue to break up. So materials are starting to outperform the energy, whereas most of the year energy has outperformed materials. You have industrials. That one is powering to we're getting, did we break above it? Yeah, this will be big resistance. Look at this breakdown area. There's a lot of breakdowns in markets in April, and we're starting to retest a lot of those areas. And those will be big tests for the market to see if they can break through. Transportation index that was relatively strong, consolidated through this week. You have the IAI to the KBE. So this is investment banks to the commercial banks, that breaking out to new highs. That's a leading indicator that, hey, markets are going to reopen, you're going to have IPOs, you're going to have bond issuance, etc. And obviously the 10-year coming down and the Fed becoming a bit looser is a good indicator. Here's XLY, the consumer discretionary. That one is still relatively weak. So the consumer is not really feeling the turn in markets. Really what you're seeing is strength in industrials. I think this is what you really have to lean on is reshoring and manufacturing, and interest rates coming down. That's going to help certain parts of the market, but fiscally, money's not going in the pockets of individuals anymore. So I think this is a healthier environment for the markets in general. Inflation, the inflation tailwinds of M2 growth, a lot of monetary and fiscal accommodations are just simply not there. And that's why throughout next year, you're likely to continue to see inflation decelerate. You could get all the way to 2 or 3% by the end of the year. And that means the Fed is going to pause. And that also means that their policy rate's much too high. They want to get their policy rate above inflation. But what I think is going to happen is I think they're going to pause and inflation is going to go right through their policy rate. Because their policy rate on the short term, let's go look at the 1 year. Here's the 1 year treasury rate. We're at 4.6%. The inversion of the shorter dated 1 year, even the 3 month. Here's the 3 month, 4.2. That's too high, right? If inflation eventually goes down to 2 or 3%, then that's going to mean the Fed is way too tight. They're going to probably cut rates. So that's kind of what the market's starting to price in. That's what's starting to price in this stronger dollar, weaker dollar, excuse me. And that's something that is good for markets. You just have to call balls and strikes. So while we're in the midst of the Santa Claus rally, and we're still likely to see volatility in the first half of next year, you can't really get too bearish on this market. Look at the S&P. You're above the 200. Look at the NYSE. You're well above the 200 and approaching major resistance. If we can consolidate here through the Santa Claus rally, what are the odds we have a rollover during December? It's possible. Anything's possible. And I think that would really be a strong signal. But if we float around these levels, go a little higher throughout the month of December, I think has to be a positive. So that's where we're at. Continued follow through. Economic data is coming in line with what the market wants, which is a more accommodated Fed. And I think that's it. Hope you guys have a wonderful holiday season. And you're probably all ramping up for your holidays and Christmas and New Year's. I thank you all for tuning in to this channel, subscribing to our podcast, InvestTalk. And I want to remind you that the content of this video are provided for educational purposes only. Should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.